The numbers are a direct contradiction. Between 1933 and 1939, German military spending exploded by 600%, fueled by an engineered currency illusion and massive short-term debt. Yet, this debt was often financed by, collateralized through, and serviced with the assistance of powerful institutions on Wall Street and in the City of London. Germany's foreign debt to the U.S. alone had been restructured in the 1920s through bonds underwritten by major American banks, debt that continued to hold institutional leverage. The Reichsbank, under Hjalmar Schacht, designed the infamous Mefo bill system, a parallel, state-backed non-public currency to fund rearmament without triggering immediate inflation or public scrutiny. These bills required discounting and eventual monetization, processes that hinged on a tacit, politically protected cooperation from global finance. U.S. and U.K. corporate subsidiaries continued to operate, profit, and often expand production inside. The Third Reich, contributing capital and technology directly to the industrial machine. The flow was not an accident of policy. It was a deliberate calculus of profit over principle. The system needed liquidity. The institutions demanded the yield. This is the financial historian, where money, power, and history collide, and nothing is ever as simple as it looks. The balance sheet does not care about ideology. To understand this, we need to start earlier. The foundation of the Nazi war economy was not built on ideology alone. It was constructed upon the rubble and reorganized debt of the Weimar Republic. The crucial period begins not in 1933, but with the Dawes Plan of 1924, and its successor, the Young Plan of 1929. These were agreements designed to reschedule and rationalize German reparation payments following the Treaty of Versailles. The key mechanism involved flotation. American investment banks, primarily J.P. Morgan and Co., and Dillon, Reed and Co., underwrote massive loans to the German state and various German municipalities. Between 1924 and 1930, U.S. capital funneled approximately $2.5 billion into Germany, a sum larger than the total reparations Germany had paid up to that point. This was the real shift. German industry, from IG Farben to Gemeinde Krupp, used this foreign capital to modernize, consolidate, and expand, laying the industrial groundwork for rearmament years before Hitler took power. The problem, however, was structural. These were loans, not gifts, and the interest payments required foreign exchange, often U.S. dollars. When the Great Depression hit in 1929, the lending abruptly stopped. In 1931, a massive banking crisis forced the collapse of Darmstädter National Bank, Danat Bank, leading to a general banking holiday in Germany. The global financial system had already created the conditions for political extremism by loading the Weimar government with short-term, high-interest debt that it could not service once the foreign capital flow reversed. The numbers told a different story. Hitler's chancellor and later Reichsbank president, Hjalmar Schacht, understood this financial architecture perfectly. His genius was to harness the existing international debt structure and corporate connections for rearmament while simultaneously implementing policies that defaulted on certain external obligations and trapped foreign capital inside Germany. This mechanism was not revolutionary. It was a clinical asset strip. In 1933, Schacht instituted the New Plan, effectively placing a moratorium on external debt service, specifically the principal repayments of long-term commercial loans, while forcing creditors to accept low-interest scrip or blocked marks. This was an engineered default that preserved the nation's foreign exchange reserves, which were essential for purchasing raw materials like iron ore and oil needed for the military buildup. At the same time, the Nazi regime created bilateral clearing agreements with Central and Eastern European countries, exchanging German industrial goods for raw materials without the need for convertible currency. The battlefield became the balance sheet, but the rearmament pace demanded funds far exceeding the state's declared revenue. This led to the creation of the Metallurgische Forschungsgesellschaft, MIFO bills in 1934. MIFO was a fictitious company. The bills were essentially government promissory notes used to pay armaments contractors. They were guaranteed by the state, had a maturity of 6 months, and crucially were renewable up to 5 years. They did not appear on the official government budget or on the balance sheet of the Reichsbank initially. They were a parallel currency, a state-sponsored form of off-balance sheet financing. By 1938, Mefo bills outstanding totaled 12 billion Reichsmarks, dwarfing the official debt. Confidence became currency. Wall Street and city involvement did not stop at the pre-war debt structure. American corporations maintained their operations within Germany, effectively subsidizing the rearmament drive. Ford Motor Company, Bofik and General Motors, through its Opel subsidiary, were key. Opel was the largest car manufacturer in Germany, and a significant portion of its production was directed toward military trucks. Standard Oil, now ExxonMobil, maintained a significant investment, ensuring a supply of aviation fuel. IBM, through its German subsidiary Deutsche Hollerithmaschinengesellschaft, or DEHOMAG, provided the punch card technology essential for the efficient management of the census, labor assignments, and the logistical planning of the Holocaust. This was a purely structural partnership. The institutions provided the means for profit, and the regime provided the political framework. Even the financing of trade was entangled. The Bank for International Settlements, BIS, based in Basel, continued to operate. In the late 1930s, the BIS, which included American, British, and French directors, was instrumental in handling and monetizing gold seized by the Nazis, including gold looted from Austria and Czechoslovakia. After the German occupation of Czechoslovakia in 1939, the Reichsbank transferred $23 million in Czech gold reserves held in the Bank of England to the BIS. The BIS accepted and monetized the transfer. This was not political endorsement. It was a financial normalization of asset theft. The global financial structure provided the necessary liquidity wash. The final punchline of Chapter 1 is simple. The Nazi war machine was economically lubricated by the inertia of the preceding decade's investment and the active, profit-driven decisions of global corporations operating under a hostile but profitable regime. The system was designed for yield, and it delivered regardless of the user. The transition from pre-war entanglement to the mechanics of the war economy itself reveals a colder, sharper institutional reality. The primary concern of the Nazi state was not solvency, but the availability of resources and the velocity of money creation. The MEFO bill system discussed earlier was the key innovation, an early form of quantitative easing and off-balance sheet leverage. These bills, guaranteed by the state, were treated as liquid assets by commercial banks and private firms who could discount them at the Reichsbank for cash. This allowed the German state to spend aggressively, up to 40% of its budget on a military buildup by 1938, without openly increasing the visible debt-to-GDP ratio, or directly printing currency, which would have triggered immediate, destabilizing inflation. This created a confidence loop. The state guaranteed the bills, the banks accepted the guarantee, and the contractors were paid, keeping the industrial base liquid. The role of the Reichsbank under Schacht, and later Walter Funk, was not merely to manage money supply, but to enforce capital control and institutional compliance. Foreign exchange controls were absolute. Non-German firms that continued to operate inside the Reich, such as Firdas and General Motors Opel, found their profits trapped. They could not repatriate their earnings freely in convertible currency. This forced reinvestment. These profits, or blocked marks, became working capital used to expand German facilities, buy local materials, and pay German workers, all contributing directly to the war economy. The power asymmetry was complete. The subsidiary provided the capital and technology. The regime dictated the usage. The liquidity dependencies were brutal and simple. The massive infrastructure of war required oil, iron, and rubber. Germany lacked all three. The system relied on bilateral trade agreements, the so-called Sperrmark, blocked mark, accounts, to procure these materials from countries in Eastern Europe and South America. These countries were paid in essentially non-transferable Reichmarks, which could only be used to purchase German industrial goods. This was a non-convertible currency trade loop designed to extract raw materials without draining Germany's meager foreign reserves. The illusion holds until it doesn't. The U.S. financial connection became even more systemic after the declaration of war, although the direct money flows were severed. The assets of the German companies and subsidiaries in the U.S. and the U.S. corporate assets in Germany created an interlocking legal and financial structure that was difficult to unwind cleanly. I.G. Farben, the chemical giant, had a critical relationship with co-owner Standard Oil concerning a synthetic fuel technology, hydrogenation. This cooperation, driven by patent sharing and joint ventures, continued until the U.S. entry into the war. The knowledge exchange facilitated Germany's ability to produce synthetic fuel from coal, a military necessity. A crucial modern case study for this rollover risk and confidence loop is Japan's current situation. Japan's national debt is over 250% of GDP. Yet, because the debt is predominantly held domestically by Japanese institutions and the Bank of Japan, the confidence loop remains intact. No immediate crisis of solvency exists because the central bank controls the yield structure and acts as the buyer of last resort. The Nazi MEFO system was the dark, state absolutist precursor to this dynamic. The state issued a bill, the central bank was forced to accept it, and the market was insulated from the reality of the expenditure. Markets enforce what politics avoids. The final structural reveal is about the post-war cleanup. Chase Bank and National City Bank, now part of Citibank, had direct relationships with the Reichsbank throughout the war even after the U.S. entered the conflict. They facilitated currency transfers for U.S. citizens in Germany and, more critically, handled the seized assets of Jewish victims. They were not merely facilitating transfers. They were operating under the rules of the Nazi regime, often to the detriment of their own clients. The institutional incentive was the continuity of business and the eventual recovery of their pre-war debt exposure. What cannot be repaid will be rolled over. The system was designed to leverage every possible financial loophole and institutional relationship to accelerate one goal: rearmament and war. The compliance of major corporations was not merely passive. It was an active calculation of trapped profit and market share retention. Confidence decides who survives. The price of yield is always complicated. The final escalation reveals how the financial structure became an engine of state control and war financing, moving from a temporary measure to a permanent institutional pathology. The initial financial engineering of the MEFO bills was a short-term solution, but as the debt mountain grew, reaching over 12 billion Reichsmarks by 1938, the mechanism itself had to be normalized. The Reichsbank began to demand that the MEFO bills be paid down or publicly converted. This transition necessitated a massive official debt increase, a reality masked by a series of forced contributions and confiscations, culminating in the complete financial servitude of the nation to the war effort. This was not a market correction. It was a state-enforced transfer of wealth. The ultimate institutional power lay in the absolute control over capital allocation. Once the war began in 1939, the Nazi state's financial mechanism simplified. It ceased worrying about external credit and focused on internal resource extraction. This involved two primary simultaneous methods. The first was the printing of money, leading to hyperinflationary pressure on the state, which was temporarily masked by price controls and forced savings. The second, and more financially significant, was the systematic looting of occupied territories. The transfer of $23 million in Czech gold from the Bank of England via the Bank for International Settlements, BIS, as detailed earlier, was only the beginning. In occupied countries like France, Poland, and the Netherlands, the Nazi regime imposed vast occupation costs, demanding payments that often exceeded the total national income of the occupied country. France, for instance, was forced to pay 400 million francs per day in occupation costs, an economic demand that liquidated French wealth and funneled it directly into the Reich's coffers. This system functioned as a massive, continuous capital repatriation program, funding the war without recourse to external finance or even further domestic debt issuance. This was economic conquest, not mere taxation. The numbers were staggering. The looting funded approximately 40% of the entire German war effort between 1940 and 1944. The continued role of corporate subsidiaries was critical here, shifting from investment to exploitation. Ford and Opel, Hacker, were entirely requisitioned by the Wehrmacht. Their facilities were repurposed for military production, and their management was compelled to comply. The same applied to all foreign-owned assets. The companies provided the physical capital, the factories, the machinery, the distribution networks, which the state then leveraged without compensation or immediate recourse. This demonstrates the ultimate institutional incentive of a totalitarian regime. It is the end user of all private capital. The modern institutional parallel to this forced compliance and resource extraction is the sovereign debt crisis, specifically in the Eurozone. Consider the Greek debt crisis of 2010 to 2015. Greece was forced into crippling austerity, not to solve an economic problem, but to service debt held by core Eurozone banks. The mechanism was different, debt restructuring versus direct looting, but the power asymmetry was the same. A powerful institutional core dictated terms to a dependent periphery, forcing wealth transfer to maintain the solvency of the center. The Greek debt to GDP soared past 175%, and the forced privatization of state assets was the modern, less violent equivalent of forced asset stripping. Markets enforce what politics avoids. The final element of the war machine's financing was the gold. Gold seized from victims of the Holocaust and from conquered central banks was laundered through neutral countries and entities, including the BIS and Swiss banks. This gold provided the only hard convertible currency needed for absolutely essential purchases from neutral countries, such as tungsten from Portugal and ball bearings from Sweden. The financial system, based on the principle of fungibility and non-scrutiny of cash and gold, provided the necessary final wash. The illusion holds until it doesn't. The entire structure, MEFO bills, capital controls, corporate compliance, and systematic looting, created an insulated financial system that was hyper-leveraged to war. It was a clinical, institutional machine designed for total financial extraction. The outcome was not a function of moral failure, but of an economic structure that prioritized the state's spending capacity above all other concerns. Confidence decides who survives. The debt was monetized by blood. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.